You've been told your whole life that saving money is the smartest thing you can do, that every dollar you put away is a step closer to security and freedom. But what if that advice is incomplete, outdated, or even dangerous in today's world? And what if quietly, slowly, without you noticing, saving money the traditional way is actually making you poorer over time? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. Let us start with a simple image almost everyone recognizes: a child dropping coins into a piggy bank, learning that saving is virtuous and spending is bad, a lesson passed down from parents to children for generations, reinforced by schools, banks, and governments until it feels like common sense rather than advice that should ever be questioned. This belief didn't come out of nowhere, and to understand why it may no longer serve you, we have to go back to a time when saving money truly did make people richer. When interest rates were high, currencies were stable, and a dollar in the bank actually grew instead of quietly shrinking behind the scenes. Decades ago, especially in the mid-20th century, banks routinely paid interest rates that beat inflation, meaning if you saved money, your purchasing power increased over time. And simply being patient and disciplined could build real wealth for an average household without sophisticated investing knowledge. In that world, saving was rewarded, debt was expensive, and inflation was relatively controlled, so the system encouraged caution and delayed gratification. And people who followed the rules were often better off in the long run, which is why that advice became deeply ingrained in our culture. But systems change, incentives shift, and rules that once worked can quietly turn against you. And the first crack in the foundation appeared when inflation began to rise faster than the interest paid on savings, a change that many people didn't notice because it happened slowly year after year. Inflation is often described as rising prices, but what it really means is your money losing value. And here is the uncomfortable part. If your savings account earns 2% per year while inflation runs at 5%, you are effectively losing 3% of your purchasing power annually, even though the number in your account is going up. That sounds abstract, so let's make it painfully concrete, because this is where many people start to feel uneasy, especially when they realize this isn't a hypothetical scenario, but the exact situation millions of savers are in right now. Imagine you save $10,000 and leave it in a standard savings account for 10 years, proud of your discipline and consistency, and after a decade the balance might show $12,000. But if prices have doubled over that same period, what used to cost $10,000 now costs $20,000, and suddenly your growth doesn't feel like progress anymore. This is the silent erosion of wealth, and it's why some economists call inflation a hidden tax. Because no one sends you a bill, no alarm goes off, and yet your purchasing power is quietly transferred away from you toward borrowers, asset owners, and institutions that benefit from rising prices. Now here's where the story gets more uncomfortable, because the modern financial system isn't broken by accident. It's designed in a way that rewards certain behaviors and punishes others, and saving cash for long periods has slowly moved from being a virtue to being a vulnerability. Central banks around the world intentionally keep interest rates low during economic slowdowns to encourage borrowing and spending, which helps economies grow, but the side effect is that savers are sacrificed to keep the system moving, a trade-off rarely explained in plain language. If you've ever wondered why banks pay almost nothing on savings while charging high rates on credit cards, this is part of the answer, and it leads to a strange reality where doing what feels responsible may actually set you back financially over time. Let's pause here, because this is usually the moment people push back and say that saving is safe and investing is risky, and that sounds reasonable until you realize that inflation guarantees a loss in real terms, while investing only carries a risk of loss, which is a very different thing. Risk feels scary because it's visible and emotional, while inflation is boring and invisible, but over long periods, boring losses can be more damaging than dramatic ones, especially when they compound quietly year after year. History gives us powerful examples of this pattern, repeating from post-war economies to more recent decades, where people who held cash watched their buying power collapse, while those who owned productive assets like businesses, real estate, or stocks saw their wealth adjust upward with inflation. Think about housing prices, for example, which often rise faster than inflation, and notice how people who saved diligently for a down payment sometimes find that the goalpost keeps moving farther away the longer they wait, even though they're doing everything right. This creates frustration, confusion, and a sense that the system is rigged, because in a way, it is, but not necessarily out of malice. It's built to favor activity, leverage, and ownership over passivity and hoarding cash. Now here's the twist most people don't see coming. Saving itself is the enemy, but unstrategic saving is, and there is a critical difference between holding money temporarily and parking it long-term in places guaranteed to lose value. Emergency funds, short-term goals, and liquidity needs absolutely require savings, but treating a savings account as a wealth-building tool in an inflationary system is like trying to run up a down escalator. It feels like effort, but you're moving backward. This is where many well-intentioned people get stuck because no one explains the transition point, the moment when saving should evolve into investing, and without that guidance people default to what feels safe even if it quietly undermines their future. Consider the rise of retirement accounts and pension systems, which emerged precisely because policymakers realized individuals could no longer rely on simple savings to support themselves in old age. Yet even today many people keep large portions of their net worth in cash out of fear. Fear is understandable, especially after market crashes and financial crises, but fear can be costly when it freezes people into decisions that guarantee slow losses instead of temporary volatility with long-term upside. One of the most ironic outcomes of modern finance is that people who are most disciplined about saving are often the ones hurt most by inflation, while those who borrow to buy appreciating assets sometimes come out ahead, even if they feel less responsible in the short term. This doesn't mean reckless borrowing or gambling in markets, and this is important because the goal is not to replace blind saving with blind investing, but to understand how money actually behaves over time within the system we live in. When you own assets that generate income or grow with the economy, inflation often works in your favor because revenues, rents, and valuations tend to rise along with prices, while fixed cash balances do not. At this point, many people ask, why isn't this taught in school? And the uncomfortable answer is that financial education often lags reality, teaching habits that worked in previous systems without updating them for modern monetary policy and globalized economies. The breaking point for many households comes when they realize that decades of careful saving have not produced the security they expected, leading to delayed retirements, increased debt, and anxiety about the future that saving alone was supposed to prevent. Policymakers have tried fixes, from higher interest rates to new savings products, but the underlying tension remains, because governments need spending and investment to keep economies growing, even if that quietly penalizes excessive cash hoarding. This brings us to the present moment, where inflation spikes, market volatility, and rising costs force people to question long-held assumptions, and suddenly, the old advice feels less comforting and more confusing than ever. So what are you supposed to do with this information, and how do you avoid the trap without taking on reckless risk? Because this is where clarity matters more than slogans or simplistic rules. The first takeaway is that money has a purpose and a timeline, and cash is a tool for short-term stability, not long-term growth, which means you need to clearly separate safety money from growth money. The second takeaway is that inflation is not a rare event but a persistent feature of modern economies, so any long-term plan that ignores it is incomplete, no matter how disciplined or conservative it feels. The third takeaway is that building wealth today requires ownership of skills, businesses, assets, or investments that can adapt and grow rather than relying solely on static balances that shrink in real terms. The warning is simple but uncomfortable. If you never question where your money sits and how it works for you, the system will quietly decide for you, and it rarely decides in favor of passive savers. The open-ended question is this: in a world where money constantly loses value, is playing it safe actually the riskiest choice of all? And what would change in your life if you started thinking of saving as a step, not a destination? Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.